Welcome back to another episode. Today we are diving deep into two crucial concepts in Binance futures trading: the mark price and the last price. These terms are essential for every trader, whether you are just starting out or an experienced pro. By the end of this video, you will understand what they are, why they matter, and how they impact your trades. Let's jump right in. Now, first, let's look at what is the last price. The last price is the price at which the most recent trade in the futures market occurred. Look at or listen attentively to these key terms. The last price is the price at which the most recent trade in the futures market occurred. Right, it is what you see fluctuating rapidly on your trading screen in the order book, right? This price is updated every time a new trade is executed, whether by institutional traders or retail traders like us. Why is it important? The last price is used to calculate your realized profit or loss, that's the P&L, when you close a position. It is also the price used for executing market orders, stop loss orders, and take profit orders. Mind you, in fact, this is one of the concepts or the two concepts in futures trading that I really had a hard time understanding them, right? Normally, when you are trading, you don't realize it, or you may not, if you are just a trader who does not mind or doesn't really care about concept or key terms or terminology, you may trade without worrying yourself. Just that you may one way or the other be encountering or having some challenges around. So it is better you have your facts right. So per my style of learning and teaching, I rather wish that, or yet would like that you understand the terms before even embarking on any kind of journey in life. So you have to understand this. Now, so back to why is it important for the last price that we are talking about. Now, the last price is used to calculate your realized profit or loss, that's the P&L, when you close a position. It is also the price used for executing market orders, that's the stop loss orders and the take profit orders. So I know basically you know what is a SL and then a take profit. SL is where you put a threshold when you enter a market and the market is going against you in the direction that, in the opposite direction of the direction that you actually wanted the market to move. So when it's going against you, you have to protect yourself with this automatic or automated orders, where the price gets to and then automatically the market or the system stop or close your entry. That's what it means, so that you don't lose more or further. So in the same way, take profit is when the market has moved in your direction for quite some time or some distance, right? But you don't want to be greedy, and then besides, you may not even know when the market may return or reverse abruptly going against you. So if you have had enough of your fill, what do? You just have to close. So the system once again automatically closes this for you. You see how convenient this is, right? So that is what is meant by SL, that's the stop loss, and then TP, the take profit, right? So that is what you have to know. So let's look at example. We have looked at why it is important for the last price, why the last price is important, and then we are going to look at the example. So imagine Bitcoin futures is trading at the 30,000, right? 30,000. If you close your position at the current last price, your realized P&L will be based on this value, right? I'm going to pause on this. Now, if the price jumps to 30,100 in the next trade, the last price updates accordingly. You understand? So I'm going to take the example again because I think the example will be best if you understand it. So imagine Bitcoin futures is trading at $30,000. If you close your position at the current last price, which is the 30,000, your realized P&L will be based on this value. You understand? Now, if the price jumps to 30,000 in the next trade, right, the last price updates accordingly. So it's just an update, like we said. That's what you are seeing the order book there. Now, what is the mark price? Now, let's talk about the mark price. Unlike the last price, the mark price is not based on actual trades. You realize that in the last price, you see them in the order book fluctuating up and down. You see the red and then the green, mean that people are entering the market. They are entering the market. They are entering the market. That is what it means, right? So it said, unlike the last price, the mark price is not based on actual trades. Instead, it is a calculated price that ensures fairness in the market. We will look at it further. Now, the mark price is derived, or let's say is calculated from one, a weighted average spot price across major exchanges. Let me take it again. One, how it is calculated, or how we derive this figure is what? A weighted average spot price across major exchanges. If you don't know what is a spot, we know spot trading, where you enter the market, you buy instantly or you sell instantly, having one asset. That is what it means. Now, second, the funding rate, which ensures the futures price stays close to the spot price. So we have spot price, we have futures price also, right? So we look at them, no worry. So I'm just want to tell you the two important things that we use to calculate the mark price. The weighted average spot price across major exchanges, and then two, the funding rate, which ensures the future price stays close to the spot price. Why is it important? The mark price determines two critical aspects, right? Two critical aspects of your trading. One, your unrealized profit or loss. That's the P&L, while the position is still open. Your liquidation, that's the two. Your liquidation price. I've talked about liquidation, where your margin is not enough, and then we have a margin call, and then eventually you are kicked out of the market. So your liquidation price, the system calculates this. Now, ensuring that sudden price spikes or drops don't unfairly liquidate your position. This normally happens during fundamentals, the news, right? There's something we call, better again, we call it slippage, where price gets executed at a point that you didn't intend, or that wasn't where you set your price. Let's say your TP or your SL or your entry, and the market does not even execute accordingly. So you understand. So that is what the mark price is taken care of. Now let's look at example how this is actually used. If the last price is 30,000 and the mark price, listen to this very carefully. If the last price is 30,000 and the mark price is 30,050, 30,050 means that 30050, 30,050, right? Your unrealized P&L and liquidation risk are calculated based on the mark price, not the last price, right? Pause the video and assimilate. Now let's look at key differences between mark price and the last price, right? It is easy to confuse these two terms, and that is the problem that I'm trying to clear, right? It is easy to confuse these two terms. So let's summarize their differences, right? The last price, the actual price at which the most recent trade occurred, right? The last price is the actual price, right? Where you see in the order book, at which the most recent trade occurred. Now let's move to the mark price. The mark price is a calculated price. So we actually come up with this value. A calculated price designed to protect traders from unfair liquidations. right? Let me pull out this diagram or picture, right, so that you appreciate this first better. So I'm going to read. I will just say something before I come to what the chart or the picture, right? So we are saying that it is easy to confuse the two terms. So let's summarize these differences. Now, the last price, right? The last price, which is the actual price at which the most recent trade occurred. That is what it means. The most recent price is the actual price. Once again, is the actual price at which the most recent trade occurred. The market price is a calculated price designed to protect traders from unfair liquidations. So now, let's look at this in picture form or pictorial form. So we are going to look at in three points: the definition, the purpose, the source, and then the volatility, right? So the aspects, the last price, and then the market price. Let's look at the definition. So it is when you look at the last price, it said it is real-time price of the latest trade, right? It is the real-time price of the latest trade. So if you check once again in the Binance, the price going up and down, you see they are very fast, swift, that you may not be able to see this. So by the system, computer is very sharp and smart. It's able to keep record of all these things. So that is why the human may not be able to fathom this. So that is it. Now let's look at the market price. It's a calculated reference price, right? A calculated reference price. Purpose determines what realized P&L. So we have realized P&L and then unrealized P&L. When we say realized, it means that when the trade has finally been closed, where you see your realized profit or loss. So now you know that your position or your trade actually end in what? In profit or loss. So that is what the last price is used for. Or yes, you understand, it determines that. And then let's look at the market price. The market price determines unrealized P&L and liquidation. So it is used to calculate this. You understand? So the market price is used to calculate unrealized P&L and liquidation while the trade is running. And then the realized one is when we have closed and then we see the figure. So you see the importance of it. So you may not actually appreciate this because at the end of the day, it's your profit that you want or your loss that you want to see. That is it. But it's a system thing. Now, the source. Actual trades in the futures market. They are actual trades in the futures market. The trades that people actually enter. Things that you see, execution, price that you actually see. And then when you talk about the market price, it's what? The spot prices and then funding rates. So you may not even be aware of this because you may probably think you are not engaging in spot trading. So why concern yourself with these terms? You understand? But it's actually happening in the futures market because in the financial market, things are interrelated. Now let's look at the source. So in the last price, it's what? Actual trades in the futures market and then spot prices and trade funding rates, right? So that is it. Now let's look at the volatility. So with the volatility, we are talking about is highly volatile, highly volatile, and then the other one is what? More stable. You understand? So let's go back to don't worry. We will now be looking at some supporting terms you need to know. Because in my explanation, I made mention of something like funding rate. And then we talked about weighted average spot price. We talked about liquidation price. We talked about high price and then we look at what? A low price. And then afterwards, we look at some analogy. Right. So, what is funding rate? The funding rate is a periodic payment between traders to keep the futures price aligned with the spot price. Right? You remember that when I was introducing this, I told you something called the financial market, where I made example or citing example, the futures, the sports, the forex, the stock, all these are interrelated, right? So that is it. So the funding rate is a periodic payment between traders to keep the futures price aligned with the spot price. If the futures price is higher than the spot price, long positions pay shorts. So long position, those in long positions, they will pay those selling, right? That is it. So if it is lower shorts pay, the short ones, they pay longs. You understand? So this ensures market balance. Let's move on again to weighted average spot price. This is an average of spot prices across major exchanges. It is used to calculate the market price, the mark price, ensuring it reflects the asset's fair value and isn't influenced by manipulation. Liquidation price. Liquidation price is the point at which your margin is no longer enough to cover your losses and your position is automatically closed. This is determined by the mark price, not the last price, to ensure fairness. High price and low price. This is besides the point, but I think it's important that you understand. High price, sometimes you when you watch your chart, yes, for a particular trade in a particular time frame, you see that you see this especially in futures trading, where you open the chart, you see that there's a mark, right? A mark above and then a mark below. This marks the higher price that the price has gotten to in the course of that time frame, and then the lower one, the lowest or the minimum price that it got to, right, in that session. So that's what it means. Let's look at this. So on the trading chart, right, the high price and low price are the highest and lowest last prices recorded during a specific time frame. These values are based on actual trades, not calculated metrics like the mark price. Let's look at some real life analogy to simplify things. I think that's what I believe in. This may sound quite technical, but let's see this analogy to make things better. Now, think of the last price as the price you see in a store. It is what people are actually paying, right? So that's the last price. The price that you see in store. Yeah, when you visit a store, you go to the shopping mall. So this is the price that you see that people are actually paying for. The mark price on the other hand, the mark price on the other hand is like the average price in the area, right? Ensuring that the store's prices are fair and consistent with the market. If the store's price, that's the last price, suddenly spikes, the average price, which is the mark price, protects buyers and sellers from overpaying or losing money unfairly. I hope you understand. So you go to the market, the shop, a particular shop has these prices that display the price tags, right? So that we determine as the last price, because that's the price that you are seeing in that shop at that moment, right? Notwithstanding, at the moment that you are in that shop, that particular same product is being sold at different areas right? So it's like there's a general price for that particular product, but when you visit different or separate or individual market stores, they have the general price. So it's like many a time it's advisable that before you go to the market to buy something, you should have a fair knowledge of the price, the general price. So I think you understand. I think with this application you understand. So the general or the fair idea or the fair price that you know is termed as the mark price. It is the mark. That is what is marked in your mind. You understand? That is the price that you have at the back of your mind before going to the market. So it's a mark price. Now, when you go to the market or go to a particular shop, the price that you see is the last price, because at that moment there's no price around you. There's no other shop around you. Let me put it that way. So that becomes the last price. It's like your last option that you can actually do. So you understand? So this is how best I can actually explain. Right. So so we are saying that you should think of the last price as the price you see in the store. Right? It is what people are actually paying. The mark price, on the other hand, is the average price in the area, ensuring that the store's prices are fair and consistent with the market. So if the store's price, which is the last price, suddenly spikes, the average price, which is the mark price, protects buyers and sellers from overpaying. So you understand? So this thing, if you have a general idea of the general price, when you get to the particular shop and you realize that this price is too much then you know that no, you are going to take a wrong decision. You are about to take a wrong decision. So for that matter, what do? You decide to buy or not, because you have the fair idea. So this fair price, which we call the market price, is protecting you from overpaying or underpaying, right? Because sometimes the whole idea, the general price that you know in general or on the market, you know that maybe for a particular item is one unit is $200. Now when you visit the shop, you realize that one particular shop is selling it $100. So you know that this is good. I am actually underpaying, which can actually be disastrous because maybe it's a fake product. But for now, you should concentrate on the fact that we are trying to understand the last price and the market price. So I think with this example, you will be good to go, right? So now that you know the difference between the market price and the last price and why they are critical for trading in Binance futures. Understanding these concepts can help you avoid unnecessary liquidations and then trade with confidence. If you find this video, in fact, if you found this video helpful, don't forget to like, subscribe, and comment on what you would like us to cover next. Until then, trade smart and stay informed. So, I'll see you in the next video where probably I will start entering trade, executing trade, and then explaining things where we put together everything that we have learned. So I will see you in the next one. Please stay tuned, like, subscribe, and share. Bye for now.